Hello and welcome to our webinar series on the topic of climate change. This third and last webinar is entitled as a good overall portfolio climate score always correspond to a positive strategy for the climate. It will be hosted by Eric Christiansen, ESG and low carbon solutions specialist at Scientific Beta, and Frédéric Ducoulombier, ESG director at Scientific Beta. If you have a question, you can use either the Q&A function or the raise hand sign at the bottom of your screen. We will address the questions at the end of the presentation. Thank you. So Eric and Frédéric, let's begin. Thank you.
So the idea of the presentation is to look at whether for an investor who is concerned about actually participating in the fight against climate change. So for an investor who is really most concerned about the real world impact, not about, let's say, the management of environmental risks for his portfolio, but on the real world impact in particular as relates to climate change, whether the use of climate scores or environmental scores is a good idea. And there are two aspects to that. First of all, climate scores at stock level, but also, and perhaps even more importantly, using an average score at portfolio level. So how does the use of such scores and average scores translate into real environmental impact? That's the focus of this presentation. So just an introduction. So the good thing about environmental scores is that you can summarize, let's say, a lot of information into one handy or convenient number. So let's say the investor has several different goals in terms of environmental impact. Climate, of course, but perhaps other goals as well, such as water management, biodiversity, air pollution, etc. So you can have a lot of different goals. And if you then want to summarize all this into one number, an environmental score is, let's say, a traditional way of doing that. And it has been touted as being facilitating comparisons across companies. So if you want to compare two companies, instead of having a multidimensional problem, you reduce that to just comparing two numbers. And that's, of course, extremely easy. And you can also do that for portfolios. So you can since you have a number, you can calculate an average number for a portfolio. So if you want to, let's say, compare two different funds from an environmental perspective, you just compare the two average environmental scores, and the answer is basically immediate. There is no more thinking to do. So environmental scores, they seem very attractive from that point of view of simplicity and comparisons of companies, and also comparisons of funds or portfolios. Now, so there are therefore a lot of investment strategies that use ESG scores when to build portfolios, and in particular there are optimization-based portfolio construction methodologies where you can, for example, target an average environmental score for a portfolio that is above, let's say, a traditional cap-weighted market benchmark. That's one frequent use of environmental scores when building portfolios. And of course, the point of this the presentation is to see what the problems are when you do such an exercise. And in the first section, we will look at the problems of individual environmental scores, and in particular, the divergence of environmental scores across different providers of such scores. In the second section, we'll look at, if you use those divergent environmental scores for portfolio construction, what can be the environmental impacts of such scores? And is that impact positive or negative, or let's say absent? And in the last part, we'll go perhaps even a little bit beyond the question of scores to look at any type of environmental metric. If you calculate an average metric at portfolio level, and if you use an optimizer to target such a metric, either as a goal, let's say maximization goal, or as a constraint in an optimization exercise. So if you use an average portfolio metric as an input into an optimizer, what can be the additional problems when doing such optimization exercises in terms of the environmental impact of such an investment strategy? That's our last part of the presentation. So the first question, we'll look at how reliable environmental scores are, and in particular from the point of view of the divergence of such scores across different data providers. And this question of divergence of ESG scores in general and of environmental scores in particular is a well-known phenomenon, and it has been studied in several academic studies, but also more recently at the end of last year, there was an in-depth review by the OECD into this question of divergence of ESG ratings. And here I say ESG ratings because if you look at, let's say, the overall ESG scores, which are built in the same way as an environmental scores, what you can observe is that there is a lack of correlation, there is a lack of convergence across providers. So typically these studies take the 5, 6 most prominent providers and calculate correlations of the scores for different companies, and they find on average about 0.5 correlation, which is quite low. So there is a range of 0.4 to 0.6, but on average about 0.5 correlation for ESG scores. And you might think that, let's say, environmental scores are more convergent because somehow they would be more objective than, let's say, social scores. But we can observe, in fact, the same level of divergence for environmental scores as we here show for ESG scores in general. So the study by Gibson et al. In 2019 found an average correlation of 0.43 for environmental scores, so in the same, approximately the same as for ESG scores in general. And what we see here is in this graph, which is taken from the OECD report I mentioned, is on the left side, you can see for the representative list of companies, you can see the different points are completely scattered, which means or reflects the lack of divergence because different data providers here, 5 different providers, come up with very different answers to the question of what's the average ESG score of these companies. And this is in stark contrast to what you can observe for credit scores or credit ratings, where there is an extremely high level of correlation. The 3 main credit rating agencies, even if they use like the different methodologies, to come up with a very similar answer, and the average correlation is 0.99 instead of the, let's say, around 0.5 that we observe for environmental scores. So now, why is there such a divergence? Why can't the different providers agree on an environmental score? And the different papers have been investigating this this question, and they try to, they have not only tried, but they managed to decompose the lack of convergence. So they have decomposed the question of the attainment of a score into 3 different aspects. One is the definition of the environmental goals. So when you say an environmental score, so what are the goals and scopes that you are trying to assess? So for example, is it climate, water, etc.? So just a list and a precise definition of what the different goals that are encompassed into an environmental score are. So the what of the assessment. But then there's a second aspect, which is the weighting. So let's say you have several underlying goals, so climate, water, etc. And how do you weight those different goals when you try to aggregate the underlying issues into one single number? And the third aspect is the measurement. So once you have identified the underlying criteria, goals that you use, what are the specific criteria that you use? And how is that done in practice by the rating agencies? Which questions do they ask? Which data sources, etc., do they ask? So how do you measure each of these individual goals that you then aggregate through a weighted average up to the top level environmental score? So 3 different aspects which you look into. And one common belief is that if you just manage to agree on the definitions on what you were trying to assess, that somehow the divergence would disappear. And this is this hope is chattered by some of the academic studies. So the first one we cite here, they find that even if you manage to agree on the definitions, there is still a divergence of at the overall scoring level. And the last one, they even find that when you decompose into these three different aspects that I mentioned, scope, weightings, and measurements, the last one is actually the most important. The measurement is the most important. So even if you would agree on the scope or the definitions, the biggest source of divergence is in fact the last one, the measurement, and that's not something that you can make disappear simply by agreeing on the common definitions and common goals and common scopes. So basically this means that the divergence is inherent in these type of methodologies of building a single ESG score based on multiplication of underlying criteria for ESG, but also for environmental scores. Now, does this mean that there is no hope to find reliable environmental data? And the answer is clearly not. The criticism one can make of using ESG scores in general and environmental scores in particular is not a criticism of environmentally related investment strategies at all. You can find reliable data, and in particular you can use, for example, carbon emissions for scope 1 and 2, which are much more convergence across data sources, which means that you can implement, the investor, the asset owner can implement a policy defining the goals, and whatever the data source they use, they will find very similar results. So you're not dependent on the data provider. You can actually express a policy, express a goal, and build an investment strategy that is consistent, whatever the source of data that is used. And this table I show here is an extract from a study from 2018, which looked into the correlation of different carbon emissions data from different providers. And what we show here is that even for estimated data, and that's important because for most large companies globally, we now have reliable data which is reported by the companies themselves, which means that basically there is no divergence at all between the different rating agencies because they all basically access and use the same self-reported data from companies, and that is more than 2/3 of companies in our developed market universe, for example, has this kind of self-reported data. But this table is not for the self-reported data, it's even for the estimated data. So even for those companies that don't self-report, where the different providers have to assess and estimate the data, we show here that there is a high level of convergence to typically the level of correlations between the different data sources is above 0.8 and even very close to 1 in some cases. So this means that scope 1 and 2 data, even when it is estimated data for those few companies that don't report, there is a high level of reliability. Now, in this section, we'll look at some of the perverse effects of using ESG scores. So not only are these ESG scores unreliable, but when you use them, you can actually have some perverse effects in terms of the impact that the investment strategies has in terms of real world environmental impact, not on the score at portfolio level, but in terms of what actually happens at the real environment, which is what many investors are concerned about. For example, if they want to participate in the fight against climate change, what they worry about is in particular the reduction of real emissions that occur. And we'll see here in this section that if you use environmental scores, the impact can be very different from what the intention of the investor is. Now, so as I said, since environmental scores are divergent across providers, it means that if you assess one company or if you assess one portfolio with one set of data and you do the same assessment of the same company or the same portfolio with another set of data, you will find very different results. And this has several implications. First of all, it questions some of the findings of academic studies, and in particular, those studies that try to show that environmental investment strategies based on environmental scores lead to what you could call an environmental alpha, or the source of additional financial returns when you use such environmental scores. And because these studies very often use one data set, if you replicate the same study with a different data set, since the data are divergent, the results of these studies are not, you will not find the same results. You can even find completely contradicting results, which means that these academic findings where you try to show that there is an existence of an ESG or an environmental alpha, for example, are not necessarily reliable. And this reliability issue can even be worsened by the fact that in some cases, the data sets are restated after the fact. And one example, which was studied by this paper released at the end of last year, looked at into one paper that had been issued right after the first COVID crisis in March, April last year. And right after that crisis, there was a paper trying to show that if you had used ESG data, you would have actually fared better during that market shock. But what the authors here showed is that this paper was based on a data set that had recently been restated, and that if you had used the data set from the same provider by using the data which was available before the crisis, you would not find such a result. So it creates reliability problems for the academic literature that try to show a positive link between environmental scores and financial performance. But that's not the most important. The most important is that if you, since there is a divergence between the different information sources, this creates uncertainty for investors, because if investors, they all agree on what they really want, let's say emissions reduction, but depending on which data source they use, they will find a different answer, which creates uncertainty. It creates risk. And since there is therefore higher risk on using environmental scores, since they are divergent, this lowers the demand for environmentally friendly stocks, because there is a risk that what you're trying to select is not actually in line with what is actually happening. So this reduces the demand for environmentally friendly stocks. It increases the cost of capital for these stocks. And therefore markets fail to efficiently allocate capital towards those companies which are really doing something about environmental problems, since there is this level of uncertainty. So inefficient capital allocation, which is suboptimal from an environmental point of view, because basically those companies who most deserve having capital allocated to them based on their environmental performance will not receive as much capital as they would have received if there wasn't this level of uncertainty, this level of divergence between the different data sources. That's the biggest problem. It's suboptimal capital allocation from an environmental point of view due to this divergence. And this is shown in particular by this paper published at the end of last year from the Scientific Beta EDEC research chair into ESG investing, which demonstrated this in a thorough mathematic manner, how divergence can lead to suboptimal capital allocation. Now, so I said it's suboptimal. So basically it means that the benefit is not as big as it could have been. What I'm trying to show here is that in some cases, the benefit can even be, let's say, negative, not the benefit. It can have a harmful impact on the environment. So the OECD in the study that I mentioned, they looked at the link between environmental scores and different environmental indicators of actual environmental harm, and in particular in this case, carbon equivalent emissions. And they found that for some of the providers, and this is what is shown here in the graph, if you have the line which is upward sloping, it means basically that the better an environmental score, which is the horizontal line, the higher the carbon emissions of the company. So there is a positive correlation for some providers between the environmental score they give to a company and its carbon emissions, which means, of course, that if you build a portfolio where you try to, where you use these environmental scores and you try to increase the average environmental scores, what you're actually doing is increasing the carbon emissions related to this investment strategy. So not only does divergence lead to lower potential environmental gains than what is expected, but in some cases you can even have a harmful impact from an environmental point of view when you use environmental scores, as is illustrated here by the study from the OECD. Now, we're coming to the third part of the presentation, where we'll look at some of the additional problems which come when using optimization techniques in building portfolios. And this is optimization techniques, for example, trying to maximize an average environmental score, but it's you can generalize the problem into any kind of environmental metric that you try to calculate an average of, and you use an optimizer to maximize that environmental metric at the portfolio level. So first of all, what the problem with using such an average metric, and in particular an average environmental score at portfolio level, is that such an average metric and average score is not meaningful unless you make some unreasonable assumptions. And in particular, if you want to view an average environmental score at the portfolio as a measure of how environmentally friendly or how good the portfolio is performing from an environmental point of view, so you're looking at an average ESG score as proxy for the average ESG environmental performance of a portfolio. If you do that, you assume that the investors have a linear utility function between the environmental score and the environmental utility or the environmental performance of that score. And this linear function, which means basically that the utility the investor receives is proportional to the environmental score, supposes that, for example, it is, if you build a portfolio consisting of two average environmental scored companies, that is equivalent to holding one which is very bad and one which is very good. That would be equivalent to holding two average ones. And what you can observe very often is that investors place much more attention to the poor ESG scores. So for example, an environmental scandal like a leak in a mine or a factory that explodes, for example, this receives much more attention than a company that, let's say, receives an award for having the best environmental policy. There is much more attention to downside aspects, to the bottom end of the scale rather than to the top end of the scale, which means that this relationship is not a straight line. There is very likely a bigger attention to the poor performances than to the top performances. So this means that this idea that you can just average them, and which assumes a linear relationship, this is not valid from most investors' point of view. Then you can also take a more financial perspective to this question. So if you view an average environmental score not as a proxy of the environmental performance, but somehow as a proxy for the environmental risks related to the portfolio. So a low, let's say a low environmental average score should or is perceived to proxy a high environmental risk. Then the problem is that you, first of all, that you, when you make an average number out of it, first of all, you assume that there is a quite strong deterministic link for each company between its individual environmental score and its individual environmental risk. And again, you are assuming that there is a linear relationship, that the risk is completely proportional to the score. When you that makes an averaging meaningful. But this assumption of linearity between ESG scores and environmental scores and environmental risks, this is undermined by, for example, a paper from 2012 that showed that basically there is a significant link between poor scores and measures of systemic firm risk, but there is no such significant link for strengths or good performances between the ratings and the risk. So there is more evidence of having a link between ratings at the bottom end again than at the top end, which again means that if you just assume a linear relationship, a straight line, this is not something which is backed up by the academic studies at this point. So, given there's an additional problem which comes when you use an optimizer to manage such an environmental score. So not only are they not necessarily meaningful, they if you use them, if you manage this kind of number, like an average environmental score, by using an optimizer. So you tell the optimizer to, for example, maximize the environmental score given a certain tracking error constraint, for example. That's a typical use of an optimizer where you use an average environmental score at portfolio level as a constraint. If you do that, you have several problems. The first one is the well-known problem of error maximization that stems from optimization uses, which means that small errors in the estimations of environmental scores can translate into big differences in the final weight given to a company by the optimizer. So it will probably find an outlier in the data set. This outlier can very well be an outlier, not because its real environmental performance is particularly good, but simply because that's the company with the biggest estimation error. And the use of an optimizer will then magnify this estimation error and will give this particularly attractive stocks or seemingly attractive stocks a very large weight in the portfolio. So when I say this about environmental scores, the same applies to any kind of portfolio average metric. So even if you used, for example, not an average score as a target, but an average weighted average carbon intensity, for example, as an average, you would have the same type of error maximization problem. And this will be my last point, but there is also another effect that you can have when using an optimizer. And that is that the optimizer will, of course, reach the overall portfolio target that you have that you have set out to achieve. So, for example, if you build a portfolio where you say, I use my optimizer to have a 50% carbon intensity reduction relative to a cap weighted benchmark, the optimizer will achieve this goal in a given year. It will also, next year, you rerun the optimization and it will very likely achieve, or unless there is some kind of impossibility in the mathematical impossibility, it will next year achieve the same 50% reduction if that's what you tell the optimizer to achieve. So on the face of it, you can communicate on a low carbon portfolio, for example, with a 50% lower carbon intensity in 1 year, and the next year you will have the same, and everything looks fine. You can claim that you have a low carbon portfolio. And what we will show now is that what happens at the average portfolio level is not necessarily something which is positive from an environmental point of view when you look at what is happening at stock level. And this is what we illustrate in this example here, where we build an optimized low carbon portfolio. So we use an optimization to maximize the level of weighted average carbon intensity and also some other financial consideration. But the carbon intensity reduction is one of the goals of this optimization scheme. And this all looks fine. If you looked at the average carbon intensity of such a portfolio, it would look very attractive. It would have more than a 50% weighted average carbon intensity reduction. But as I said, this overall goal, which looks fine, is not necessarily positive when you drill down into the portfolio decisions that you have made. And in this table, for example, we look at what happens to the worst companies in terms of carbon intensity. So if you take the 10% worst companies in terms of carbon intensity from one year to the other, so you do this 1 year and you do the same exercise the next year, you can very often see, in some cases, as you see in the middle column, more than half of the time, the worst companies can actually increase in weight from 1 year to the other when you rerun the optimization exercise. You can also see that in some cases, the optimizer actually finds companies that are among the real worst in terms of carbon intensity, but the optimizer would still overweight that company relative to the standard market benchmark, simply because it might have other attractive characteristics in terms of, let's say, factor exposures, or it could be other financial constraints like tracking error contribution, for example. If it finds one company which has so attractive financial considerations that in the overall scheme of things, it's a positive contribution, it might actually overweight that stock, even if it's in the worst decile in terms of carbon intensities. So again, the portfolio on average in total would look very attractive. When you drill down into specific companies and look at, for example, the worst carbon intensive companies, things look very different. You can increase your weight over time, or you can overweight them even relative to a cap-weighted benchmark, and still achieve an average goal that looks attractive. And the problem with this is that you're sending extremely inconsistent signals. So the overall signal that this strategy aims to send is to say, I want to reduce the carbon intensity of a portfolio. So I, as an investor, I'm concerned about carbon intensities, and hopefully this would incentivize companies to do something about their carbon intensities. But the thing is, when you look at what happens at the stock level, this is completely inconsistent. So the overall speech of the investor, the overall goal of the investor is not consistent with what is actually happening for each stock, which means that when a specific company looks at what real investment decisions have been taken by the investors, so not only the speech, but the real actions, when they look at the real actions, they will see that it's completely inconsistent in many cases. And this reduces the incentive and the willingness of companies to actually do something about the carbon emissions. So it means that, of course, if you want to reduce emissions, it's not investors who need to reduce their emissions, it's the actual companies which do emit those CO2 volumes. It's them that need to do something about it. And if you don't give them the right incentives, they will not do that. So, and this, in summary, is a pure greenwashing exercise, in the sense that you're having a nice speech, you're saying something at portfolio level which looks nice. You have achieved, for example, a very strong carbon intensity reduction, but it's greenwashing in the sense that what is actually happening, the result of this in the real world, is something completely different from the speech and the overall number that you are reporting on and that you are publishing. Now, so in conclusion and in summary, so at the beginning we showed that individual environmental scores diverge widely across providers, and there is no hope of reducing this divergence by simply agreeing on common definitions. So even if a regulator were to, let's say, regulate the definitions of what good environmental performance means, it would not solve the problem. There would still be a high level of divergence at the environmental score of different providers. So that's not the solution. The solution is not to take the environmental scores and ratings and try to solve it by common definition. That's not the good way to go about it. You should rather use environmental data which is reliable, and we have showed, for example, that scope 1 and 2 emissions across providers are reliable even when the data is estimated, so not self-reported by companies. You could also use other environmental metrics, such as, let's say, revenues from coal or other fossil fuels. You could use revenues linked to climate solutions, for example. These would be more objective data and would not be a source of divergence in the same way as environmental scores are. So there exists reliable data that we can already use, so there is no reason to rely on environmental scores. And one of the problems, and this might seem like only a technical issue, but it's actually an important issue in terms of the real environmental impact of these strategies. Because what we have shown, and this has been documented in recent academic studies, is that this divergence, this disagreement between the data sources is a source of uncertainty, a source of risk for investors, which leads to suboptimal and even, as I showed in one example, counterproductive results in terms of the real environmental impact of such strategies. So it's not purely a technical issue for investors, it's actually a grave concern when it comes to the environmental impact of these environmental investment strategies. But again, since there are good data available, you can build investment strategies with strong favorable environmental impacts based on these data sets. But we, as we have previously done, warn against using, for example, an optimization-based approach when building such portfolios. So even with, let's say, reliable data, if you have an optimization approach where you simply put this data into an optimizer based on a portfolio average metrics, such as an average environmental score or an average carbon intensity, you will encounter problems, in particular error maximization problems, but also, and perhaps even more importantly, a complete inconsistency between the stated number of at the portfolio level, which looks fine, and what is actually happening at the level of stocks in your portfolio. And there you can have investment decisions, investment actions at stock level, which are completely contradictory with the overall goal, with the overall number that you are focusing on through the optimization. So yes, it's possible to build strategies with positive environmental impact based on reliable environmental data, but you should be careful about the data that you use, and you should also be careful about the construction technique. In particular, when using optimization methodologies, you can have greenwashing problems between the stated goal, the stated number at portfolio level, and the actual impact that you have on the environment. So that summarizes the presentation today, and now we are open for questions with Frédéric, and we will be very happy to answer them.
Thank you very much, Eric. We already have received a few questions. So the first one is, do you think that the divergence of scores across providers may also be due to differences in universe coverage, i.e. as a small comparable universe of companies are analyzed across providers, they are more subject to statistical bias?
Yeah, I'll take this. So the idea there is that if you focus only on the stocks that are part of each provider universe, you have a small sample, and therefore the results, the correlations that you are showing may not be so statistically sound. Yeah, it's a good question. So in fact, I've seen, and Eric has shown some figures that were doing provider to provider correlations. So the issue there is limited. The amount of joint coverage will be high for these, and I've seen studies with even at the country level, hundreds of stocks covered by different providers. Yeah, even for those one-to-one comparisons, you see these poor levels of correlation. So nowadays the major providers have achieved high coverage of the developed universe and some of the emerging universe. So you're talking about comparisons that are based on 1,000 plus, going towards 2,000 plus stocks. So these results are quite reliable.
Thank you, Frédéric. Another question. Do you have an explanation why the optimizer picks up on the most carbon intensive stocks? Is it due to sector constraints on the optimizer?
So in this exercise, we showed basically the portfolio has a dual goal of maximizing carbon intensity reduction and on maximizing factor exposures. So it's a dual investment strategy. So it both has environmental goals or one environmental goal and one financial goal. So in this case, these companies would have attractive factor attributes. So for example, they would be high momentum stocks or high value stocks, etc. So in this case, if the company finds or the optimizer finds one stock which has a very poor carbon characteristics, but has stellar factor attributes, it would still overweight that company or increase its weight over time. But so it depends on what you put into the optimizer. You could put, but the same would apply if you do a more simple exercise where you just, let's say, maximize the carbon aspect given a tracking error constraint. In that case, it would, if it finds one company which has extremely low marginal tracking error contribution, for example, it might still put a lot of weight into that company, even if it had very poor carbon characteristics. So it would depend on how the optimization scheme is run. And it could also be due, for example, to some constraints in some cases, because typically the optimizations are, you add different constraints in terms of, let's say, liquidity, or as you refer to, you could have constraints in terms of sector allocations, for example. So let's say in a given sector, if you take a high carbon intensity sector, the optimizer would tend to give a very low weight to all the companies in that sector. But very often you impose a constraint, and one such constraint would be a sector neutrality constraint, for example. So you build an optimized portfolio with a sector neutrality constraint. And then what might happen is that within that sector, where basically all companies are carbon intensive, it might find one that for some reason is not as carbon intensive as the other one in its sector. And given the sector neutrality constraint, that specific stock would then receive a huge weight to compensate for the down weighting of the other stocks. So it does depend on how the optimization scheme is run, whether it's the other inputs which are put in parallel or constraints that are put in place. But it might lead to such effects where you have something for a specific stock or for some stocks which is completely incoherent with the overall objective of the portfolio.
Thank you very much, Eric. We have a question. How do you suggest to reduce CO2 scope 1 and 2 if not using optimizer?
Well, you could perform exclusions based on emissions or emissions intensity. So you could be excluding based on the carbon intensity performance of stocks within sectors, for example. So you could have a best-in-class, worst-in-class type of approach. Or if you would want to have exclusions, you could relate the weight of your index constituents, your portfolio constituents, to the level of carbon intensity. Naturally, as Eric said, if you want to do that also to promote change at the company level, then you should be wary of not mixing this carbon intensity data with financial data. You would not be just tilting a cap weight or a financial determined weight with the intensity. But yeah, you could do it through weighting as well.
Thank you very much, Frédéric. Do you think that the differences in the scores of the providers will disappear with time?
No, very clearly, as we showed, because you might hope, for example, that definitions converge over time. So let's say if the regulator sits down and say, okay, this is how we define the environmental goals, and you should all apply the same goals and the same scopes in your assessments. And the hope is then that over time, this would contribute to the disappearance of the divergence. But as we showed, most of the divergence is due to how each agency in practice assesses the different goals. So there would subsist a high level of divergence, even if you would agree on definitions, and even if, let's say, investors would agree on what the weightings of the different underlying criteria was to be, there would still be a high level of divergence, and this won't disappear because every agency, even for commercial reasons, they have a need to rely or want to rely on proprietary methodologies because they will try to show that their rating is better than the rating of their commercial competitor. So there would be proprietary methodologies in terms of assessment, and these proprietary methodologies, the difference between these different proprietary methodologies would be sufficient to maintain a high level of divergence. So it means that the divergence will not disappear over time.
Thank you, Eric. Do you expect that correlations between ESG data providers would increase when ESG regulation become stricter and more developed?
Good question.
Yeah.
No, there is some. So again, we're criticizing ESG score, let's say aggregate or a score which use multiple underlying criteria and use some. That's what we're criticizing. There will be environmental data which is useful. There already exists. Scope 1, 2 emissions, for example, is an example. But let's take the example of green solutions or climate solutions, which is a very important aspect in the new net zero investment frameworks, because they all favor not only carbon emissions reduction, but also investments in climate solutions by companies. And there, regulators can play a role, and they are already doing that, in particular at the EU level with the EU taxonomy. So trying to have a common definition of what an environmental activity is. But this, once you have the common definition there, you can quite objectively define the level of revenues linked to those environmental products, and then you can have a high degree of convergence between the different data sets, given that the regulators has had a clear definition of the different activities. But that's not a score, it's basically the definition of an activity, and you measure the revenues, which are monetary and therefore can be measured through the accounts of companies, and there regulators can contribute to having a convergence of data sets in the future. So nowadays there are already commercial products for green revenues or climate solutions. It's difficult to say exactly how much these different data sets converge. I haven't seen any result of that, but clearly we'll see a convergence given in particular the EU taxonomy project for this type of data. So they're already useful data because they're based on revenues indicators, involvement indicators, but we can expect that in the future, given a regulation, that will have even better or more homogeneous data in that set. So yes, regulators can contribute. We'll see improvements in some data types, climate solutions in particular. So some data will improve, but we don't believe that for ESG scores or environmental scores that there is any hope for improvement.
Thank you, Eric. We have a question. Agree that we cannot rely on E or ESG scores for a firm's contribution to fight against climate change. What metrics can you look at to assess a firm's contribution to this effort?
Okay, well, I think Eric largely discussed this already with his last question, but yeah, I'd say when you look at the net zero asset owner frameworks out there, you see two important dimensions in contributing to climate change mitigation. There is the reduction of emissions approached as much as possible within sector decarbonization pathways on the one hand, and on the other hand, there is the increase of portfolio allocated to climate solutions. So yeah, if E or ESG scores are unreliable, there is an amount of a good amount of convergence on emissions. There beyond emissions, there are some interesting data out there on companies' commitments to decarbonization, such as the Science-Based Target Initiatives commitments. And these also cover commitments towards Scope 3 reduction and are approached firm by firm. So these are interesting forward-looking criteria you can take into account. And as Eric was saying, on the solutions front, you already have some revenues data, and their convergence will increase with the rise of the taxonomies in Europe and other regions of the world. So these are the type of metrics that we like. Revenues linked to climate damage or climate mitigation on the other hand. Emissions taken at current emissions level or with a forward-looking view in the context of targets that have been validated externally and that in the future will be reviewed every 5 years. These are the type of metrics that we like.
Thank you very much, Frédéric. Another question for investors concerned with the real impacts of their climate strategies. What are the lessons of these studies and your observation on portfolio level targeting?
Yeah, well, I'd say you can't build impact on the basis of metrics that are subjective or divergent, because you cannot build signals that at the market level would be consistent, and also you cannot engage companies based on these metrics that are too subjective or divergent. So that's one key point. Be careful about the data you use for your portfolio construction and engagement activities. And the second point was this the need for consistency between the objective that you profess at the portfolio level and what you are doing at the stock level, and that puts some restrictions on what you can do in terms of portfolio construction. You should be, if you want to have an impact at the company level, you should work from the bottom up and not from top down with an optimizer. If you fail to do that, you are also, to some extent, undermining your engagement effort, as the signal that you are sending through portfolio allocation, well, is misaligned with what you are saying. Obviously, if you are consistent in portfolio construction and engagement, you are leveraging the potential power of engagement. Eric, you want to add anything to this?
No. Yeah, I think that's clear.
Thank you very much. We have time for one last question. On the last slide, before the summary, can you please add some further color on how portfolio optimizers actually reduce the portfolio level average carbon intensity if they increase the weight of carbon intensive companies?
So in this column, the increase is over time. So it's from 1 year to the other. So when we say they reduce them by 50%, I was mentioning at one point in time, they reduce, let's say, by 50%, or you can put another number there, 40% or 30%, as in the CTB versions of EU compliant indices, for example. So that's a reduction at a point in time. In this column, we were showing an increase in time. But you could achieve an average, at one point in time, you could achieve an average reduction of 50% to 40%, even with a high weight in one specific stock. So for example, in the right column, we see that even when you have a high weight or an overweight relative to cap weight in high stocks, you can still achieve a very high average reduction at one point in time, simply by focusing on other companies, because you have it here. This is in the US universe. We have 500 stocks. The optimizer has 500 different constituents to play around with. So we can still give a high weight to some companies in a particular point in time, and reduce and have a good reduction at the average level. So that's still completely possible at one point in time. From 1 year to the other, it will do the same. The optimizer, basically, when you run the optimization, it will just run the same exercise again. It doesn't actually necessarily care about what happened the year before. So it might come up with a new solution the year after, which is completely new. And then the new solution might increase the weight in one stock from 1 year to the other, but because the optimizer doesn't really care about what was the prior position. And the new optimal solution from the optimizer's point of view might be leading to a strong increase from 1 year to the other, because that's not something that the optimizer actually looks at. If you really want to care about consistency over time, you need to build that into the portfolio decision. And the easiest way is to have, if you have a very clear linear link, for example, between the carbon intensity of a stock and its weight, that means that essentially that the year after, if the carbon intensity worsens, well, the weight also mechanically is reduced. So you can build a very simple rule where if the weight is simply linked to the carbon intensity, then you don't need to go through an optimizer. And from 1 year to the other, or at one point in time, essentially the weight will be consistent with the goal without going through an optimizer. The optimizer in itself won't care about what happened the year before, and given that it has hundreds of different stocks to play around with in order to reach one single number, it can do that even when doing something which is completely inconsistent for some stocks.
Thank you very much, Eric. So we are now approaching the end of our webinar. So thank you very much to you both. We will be sending you the materials and recording of this webinar very shortly. Thank you again for your time. We of course remain at your disposal for any follow-up questions you may have. You can contact us at the email address webinar@scientificbeta.com. Thank you very much and goodbye.
Thanks.
Thank you.